All right, let's talk about a topic that is, and I'm not exaggerating, the absolute foundation of financial reporting: accounting standards. Look, understanding why these rules exist is just as important as knowing what the rules are, especially when it comes to your exams. So let's dive right in.
Okay, let's kick things off with a classic ICAI exam trap. Picture this. You have two companies. They are identical in every single way. Same sales, same purchases, same operations. Is it possible for them to report completely different profits for the same year? Your first instinct is probably to say, no way, right? Well, the answer is a big, flashing yes. And not understanding why is a classic pitfall where students lose a ton of marks.
And here's exactly how that happens. Look at this. Company A decides to use the FIFO method for its inventory valuation and shows a profit of 1,20,000 rupees. Meanwhile, Company B, remember, it's the exact same company operationally, uses the weighted average method, and its profit is only 95,000. If you're an investor or anyone looking at these numbers, how on earth are you supposed to compare them? It's total chaos. And this is exactly the problem we face without a common set of rules.
This brings us straight to the core issue, what we call accounting's comparability problem. Think about it. If every company could just pick and choose its own accounting methods for everything, inventory, depreciation, you name it, financial statements would be a mess. You couldn't reliably compare a company like Infosys to TCS. You couldn't even compare Infosys's results this year to its own results from last year. For investors, for banks, and most importantly, for you in that exam hall, this kind of ambiguity is a huge, huge problem.
So, we have this big problem of potential chaos. What's the solution?
Well, the solution, of course, is accounting standards, or AS. The simplest way to think about them is as the official rulebook for financial accounting. They are written policy documents laid out by experts that create a common language for everyone. Their entire purpose is to bring order to the chaos, to ensure consistency, transparency, and, you guessed it, comparability in financial reports.
Now, this is super important. Every single accounting standard, no matter what it's about, is built on these four pillars. They always answer four basic questions. First, recognition. When should we actually record this item in our books? Second, measurement. Okay, we're recording it, but at what value? Third, presentation. Where exactly does this thing go in the balance sheet or P&L? And finally, disclosure. What extra information do we need to tell people in the notes to accounts? If you can get these four pillars down, you can understand the basic structure of any standard they throw at you.
So, we know what they are, but why do they really truly matter? Especially for you and your exams.
The advantages of having accounting standards really boil down to these three core benefits. You've got standardization, you've got additional disclosures, and you have comparability. Let's quickly break down each one, because understanding these is absolutely key to nailing those theory questions.
First up, standardization. This hits the problem we saw at the very beginning head-on. By creating a set of rules, standards get rid of all those confusing variations. It also helps to curb what we call creative accounting, where companies might try to bend the rules to make their profits look better than they actually are. Standards make that a whole lot harder.
Second, disclosure. Now listen up, because this is a gold mine for marks in your exam. Accounting standards force companies to reveal more than just the basic numbers. They make you explain the how and the why. So going back to our example, you can't just state the value of your inventory. You must disclose whether you used FIFO or weighted average. That transparency is everything, both for investors and for the person marking your paper.
And the third big benefit, which is really the end goal of all this, is comparability. Standards allow for two critical types of comparison. First, there's intra-enterprise comparison. That's just a fancy way of saying you can compare a company's performance this year to its performance last year and the year before. Then you have inter-enterprise comparison, which is when you compare one company, say Tata Motors, to another in the same industry, like Mahindra & Mahindra. Neither of these would be meaningful if everyone wasn't playing by the same rulebook.
Okay, everybody pause. Massive exam tip coming up. This is a favorite of the ICAI. What happens if an accounting standard says one thing, but a law, like the Companies Act, says something completely different? The answer is simple, and you must remember it. The law always wins. The statute, the law of the land, will always prevail over the accounting standard. They love to test this in MCQs, so please burn this rule into your brain.
So we know what they are and why they're so important, but have you ever wondered where they come from? How are these rules actually made? Let's go behind the scenes.
In India, there are four main players in this game. It all starts with the ICAI, our institute, which set up the Accounting Standards Board, or ASB. The ASB's job is to do the heavy lifting and draft the standards. Then, the National Financial Reporting Authority, NFRA, steps in to review that draft and make its recommendations to the Ministry of Corporate Affairs, or MCA. And finally, it's the MCA that gives the official stamp of approval, notifying the standard and making it law for companies.
This entire process follows a very clear, very structured 8-step journey. It's a long road from just an idea for a standard all the way to it becoming a mandatory rule. Let's quickly walk through how it works. So the whole thing kicks off when the ASB spots an area that needs a new standard. They form a study group with experts who prepare a first draft, but this doesn't happen in a vacuum. That draft is then sent out to all the big players, the MCA, SEBI, the CNAG, to get their expert opinions. The ASB then actually meets with these bodies to discuss everything.
After getting all that initial feedback, the ASB then releases what's called an exposure draft to the general public. And this is really important. It means anyone, from big corporations to academics to individual accountants, can send in their comments. The ASB has to consider all of this feedback, make changes, and then submit a final draft to the ICAI Council. Once the Council approves it, the standard is officially issued.
And this whole process has the force of law behind it. Section 133 of the Companies Act 2013 makes it crystal clear. It says the central government can prescribe accounting standards. But, and this is the key part, it has to be based on recommendations from the ICAI and only after consulting with and getting the green light from the NFRA. This quote legally ties together all the players we just talked about.
All right, let's wrap this up by taking a quick look at the current state of play. What does the world of accounting standards in India look like right now?
So, as of today, the ICAI has issued a grand total of 29 accounting standards over the years.
But it's important to know that 2 of these have been withdrawn. AS6, which was on depreciation, got pulled because all of its rules were basically absorbed into the new and improved AS10 for property, plant, and equipment. And it's a similar story for AS8 on R&D, which became redundant once the much broader AS26 on intangible assets came into effect.
So if you do the math, 29 issued minus the 2 that were withdrawn, the key number to remember is that there are 27 effective accounting standards that are currently applicable.
So let me paint you a picture. It's a classic exam-style problem. You have a company. Net worth is over 600 crore rupees. They've got the best finance team money can buy, and their financial statements get completely rejected. Why? It's not because they didn't know the rules. It's because they applied the wrong set of rules. And believe me, this is a very common trap. And knowing this distinction is where you're going to pick up those crucial marks.
Because really, what we're talking about today is way more than just rules and regulations. It's about learning to speak the global language of finance. It's the difference between a company that can only talk to Indian investors and one that can talk to the entire world. So let's get fluent, shall we?
So let's start at the very beginning. Why did we even need a change? Why couldn't we just stick with our good old accounting standards? Trust me, if you understand the problem, it makes remembering the solution, which is Ind AS, a whole lot easier.
Think about it. Before a common standard, the world was a mess, financially speaking. Imagine trying to get funding from a New York investor when your books are written in a way they can't understand or trust. How could someone in London possibly compare a company in Mumbai to one in Berlin if they're all playing by different rules? This created so much confusion, a total lack of transparency, and frankly, it made it easier for fraud to happen. It was a huge barrier to global investment.
And so the world came up with an answer to this accounting language barrier. And that answer was IFRS, International Financial Reporting Standards. This became the new gold standard for financial reporting across the globe.
So, where did IFRS come from? Well, the story starts way back in 1973 with a body called the IASC. They started issuing the original standards, which were called IAS. Then, in 2001, things got a major upgrade. A new body, the IASB, was formed. Now, the IASB started issuing new standards called IFRS. But, and this is a really key point, they didn't just throw out all the old IAS, they adopted them. So the global standard today is actually a mix of the older IAS and the newer IFRS. Okay, this is super important. When we say a company is IFRS compliant, we're not just talking about one thing. The term IFRS is really a whole package deal. It includes the new IFRS standards, the old IAS standards, plus all the official interpretations for both, which are called IFREC and SIC. It's the whole shebang.
So as the world started moving towards IFRS, India was at a crossroads. We had a huge decision to make. Do we just take IFRS as it is and implement it directly, or do we adapt it, create our own version that's in line with the global standards, but suited for us? This was a massive strategic choice.
Let's look at the two options. Option 1 was adoption. Think of this as the copy-paste approach. You just take IFRS word for word and use it. Option 2 was convergence. This is more of an adapt and align strategy. You take the core ideas of IFRS, but you tweak them to fit our own laws, our economy, and our business practices. As you know, India chose the path of convergence, and that's how Ind AS was born.
And why was this such a game changer? Well, convergence gave us the best of both worlds. Suddenly, our financial statements were way more trustworthy for global investors. It became much, much easier to compare an Indian company to an international one. For our big Indian MNCs, putting together their global accounts got a whole lot simpler. And importantly, it opened the doors for Indian companies to get listed on big international stock exchanges.
All right, now let's get into the nitty-gritty of Ind IS itself. This is where the real exam questions come from, so let's really focus in here. We're going to break down what exactly makes Ind IS different.
Okay, one of the most critical terms you have to know is carve-out. So what is it? A carve-out is a deliberate, planned difference from IFRS. It's where India looked at a global rule and said, you know what, for our specific economic situation, we need to change the fundamental accounting principle here. It's not a mistake, it's a specific reason modification to the core principle.
And here we have a classic ICAI trap. Seriously, pay attention here because marks are lost on this all the time. Not every single difference between Ind AS and IFRS is a carve-out. For example, IFRS calls it a statement of financial position, but our Companies Act says we have to call it a balance sheet. That's just a name change, not a carve-out. Or, and this is another common trick question, if IFRS gives you two options for accounting treatment and Ind AS says you can only use one of them, that is not a carve-out. That's just removing a choice. A true carve-out changes the fundamental accounting principle itself. Don't mix them up.
Now, the opposite of a carve-out is a carve-in. This one's much simpler. It's just any extra guidance or rules that we've added into Ind AS that you won't find in the original IFRS. So here we're adding something new, not changing what's already there.
So after all these carve-outs and carve-ins, where does that leave us? Well, it means that right now in India, we have two parallel systems running. We have the old existing accounting standards, AS, and we have the new IFRS Converged Indian Accounting Standards, or Ind AS. And the million-dollar question for you, for your exams, and for every accountant in the country is figuring out which set of rules a company is supposed to follow.
Which brings us to the Ind AS roadmap. And I cannot stress this enough. This is one of the most important, most frequently tested topics in your entire syllabus. You absolutely have to know the applicability criteria, so let's nail this down.
So before I show you the answer, just take a second. Try to remember. What's that magic number? What's the net worth threshold that triggers the switch to Ind AS?
The number is 500 crore rupees. Burn this number into your brain. If a company's net worth hits 500 crores or more, that is the trigger for mandatory application of Ind AS.
So from April 1st, 2016, any company, doesn't matter if it's listed or unlisted, with a net worth of 500 crores or more, had to switch to Ind AS. But here is the classic ICAI twist, the part you have to remember. The rule doesn't just stop at that one company. The moment that company crosses the threshold, it sets off a chain reaction. Its parent company, all of its subsidiaries, its associates, and its joint ventures, they all have to adopt Ind AS too, even if their own net worth is small. The entire group gets pulled in. This is a huge point, and it gets tested all the time.
All right, last section. Let's make sense of the standards list itself. I know it can look a bit intimidating, but there's a really simple trick to understanding how Ind AS numbers correspond to the IFRS numbers.
Here's a little hack for you. It's super simple. If an Ind AS is based on one of the older IAS standards, the number stays exactly the same. So IAS 16 becomes Ind AS 16. Easy. But if the Ind AS is based on one of the newer IFRS standards, you just add 100 to the number. So IFRS 3 becomes Ind AS 103. This logic works for all of them.
Let's just see this in action and make sure it sticks. Ind AS 103? Well, that's based on IFRS 3, so we add 100. It replaces the old AS 14. Ind AS 116 is based on IFRS 16, so again, add 100, and it replaces the old AS 19. Now what about Ind AS 16? That one's based on IAS 16, so the number stays the same. Same thing for Ind AS 38, which comes from IAS 38. See? This simple pattern can save you a ton of memorization effort.
And there you have it. We've covered the whole story, the why, the what, and the when.
From the global problem to the IFRS solution, India's path of convergence, the key definitions, that critical roadmap, and even the numbering system, you now have the complete foundation. Your next step is to master the how for each individual standard, and you're perfectly set up to do that. Keep up the amazing work and all the best with your studies.